And we're going to continue our conversation about risk assessment. So we started looking at what we are calling this audit risk model. And this audit risk model is what helps us sort of plan, lay out a roadmap for how we want to approach our audit. And so we, in the first chapter of this class, really just talked in general about what audit risk is. It's the risk that we could form the wrong opinion on the financial statements, right? We issue that unqualified thumbs up opinion when in fact there are material misstatements in those financial statements. But then here in chapter 2, we're breaking it down and we identified 3 individual components of audit risk that we have to sort of think about and plan for. What was one of the components of audit risk that we talked about on Wednesday? Give me one. Yep.
I think it's IC.
You're combining 2 of them. IR, which stood for inherent risk. So the first risk, inherent risk, that's our just because, right? Just because the financial statements have complicated, complex, weird, funky accounts in it, there could be a risk that there are material misstatements in there, right? What was the second one? Michaela? Control risk, right? Their internal control system isn't working. Therefore, their business processes are not preventing or detecting misstatements. So we're worried that there's misstatements in those financial statements because their internal controls aren't preventing them or detecting that they've occurred. Yes? So these 2 are assessed by the auditors, right? It's our job, and that's what this chapter is about. That's what your case study is about. We are trying to assess inherent risk and control risk. And we began discussing sort of how we do that. We'll continue that here in a second. The reason why we assess inherent risk and control risk is because then we need to choose the final component of this, which is, detection risk, which I abbreviated as DR, right? So we choose our level of detection risk. Detection risk is how much risk do we want to bear on our shoulders that we're not going to find misstatements in the financial statements, right? And that's dependent on, well, are their internal controls working? If so, that's good. We don't have to worry as much. And are there no like complex, funky, weird accounts in those financial statements? Again, that's good. Then we don't need to worry as much. So we choose detection risk based on our assessment of inherent and control risk. And when we choose detection risk, what essentially how it sort of flows through the rest of our audit plan is that determines our materiality. Is it going to be higher or does it need to be lower, right? And then materiality helps us determine how much do we have to actually audit, right? Because we talked about if we have a high level of materiality, then that means all those low dollar value items that you see on the financial statements, you don't even have to gather, you don't have to look at, right? Because we are willing to accept a high level of detection risk. We set materiality high, and that means we don't have to audit those low dollar value items. But if we decide that we're not willing to accept a high level of detection risk, we don't want that on our shoulders because maybe their internal controls aren't working very well. So there's material misstatements that we're worried about in there. Or maybe they got a lot of weird, funky stuff going on. And again, that could create misstatements in the financials. We would choose a low level of detection risk. If we choose a low level of detection risk, then our materiality thresholds are also going to be lower. That means that anything, right, and let's use numbers. Let's say that our high level of materiality is $1 million and our low level of materiality is 250,000, right? If we pick this, anything below $1 million, we don't even audit. But if we pick this, there's a bunch of stuff that we wouldn't have had to audit that we now are going to be concerned with. Does that make sense? So this risk assessment is leading us to what are we going to audit, right? What does our audit plan look like? That's why we have to perform this risk assessment process. So we talked about all of that in our previous lesson. So I'm skipping down to where we left off, which is our auditor's risk assessment process. So how do we, right? We've said we understand what inherent risk and control risk is, and we understand that it's our job to assess what inherent risk and control risk is for our client. How do we do that, right? And so we said, well, we start with conversations with our client. We just discuss our concerns with management. We talk to them about their business processes. We perform analytical procedures, again, which you did in some of your Chapter 3 case, where you said, hey, let's figure out where there are red flags, okay? And we can look at analytical procedures to help us do that. And then we can just observe how the business operations run. We go out to the client site, and not only can we talk to them about how business processes work, we can walk around the manufacturing facility and see it for ourselves. We could talk to people in payroll and watch as they process that payroll every month, right? We can observe as we are trying to get an understanding of our client. So that's what we do to understand our client. And this is what we're trying to understand about our client. This is where we left off on Wednesday. What we are trying to understand about our client is the nature of their business. Let me blow this up a little bit. I know that's probably hard to see. The nature of their business. What kind of accounting principles do they have to follow? What industry or other external factors have an effect on their business? What are their objectives and how do they achieve those objectives? What strategies do they put in place? What are some of their key performance indicators? What's the measuring stick that they set for themselves to determine whether or not they're performing well? And then finally, what does their system of internal control look like? So again, this is where we left off on Wednesday. And now we're going to walk through each one of these things individually. Keep in mind that your case study for Earthware is more so focused on this one, the nature of the business, okay? So what kinds of things would we be looking for when we're trying to get an understanding of just how this business runs, right? We want to know, what's the organizational chart look like, right? Who reports up to who? How many executives do they have? Does each department have a series of managers? What does that look like? And what is the reporting mechanism sort of up that hierarchy and down, right? There needs to be communication going up, but there also then needs to be communication coming down as well, right? Those executives, those managers giving information down to the sort of the people who are sort of running the everyday transactions. What are some significant investments that they have, right? Have they invested their funds into other businesses? What does that look like? Have they expanded recently, right? What's the size? What kind of locations? Where are they located geographically? What are some of their key revenue streams? How do they make money, right? What are their key products and services? And then where do they get those key products and services from? Key suppliers. Who do they sell those products and services to? Key customers, right? These are the kinds of things that we want to understand about the business, because by understanding these things, we can identify where there might be areas of risk, okay? And again, this is the one that you are most focused on in the case study for Earthware for Chapter 4. And after we're done with our lecture, I'm going to walk back through the instructions of that case study just so everybody's on the same page. Okay, so we are trying to get an understanding of the nature of this business. We are also trying to get an understanding of their accounting policies, right? So have there been any significant changes to accounting rules that have an effect on this business, right? When revenue recognition, those of you who have had intermediate one or are in intermediate one, when revenue recognition changed maybe 4 or 5 years ago, it had a significant effect on a variety of different industries. And so we want to have an understanding of what are the changes going on in accounting principles that have an effect on our client. We also want to know, right, are there any significant accounts or disclosures, footnotes, that require a lot of management estimates, right? Those are high areas of risk. If there are significant material amounts on the financial statements, and those amounts appear there as a result of management making estimates, we all know that estimates is a fancy accounting word for guesses. They're guessing, you guys. They're guessing, right? And so we as the auditors have to really understand where are those areas where their judgment is significantly involved in what results on the financial statement. So areas of judgment, and then also emerging areas. So when cryptocurrency first came out, there was not a single accounting rule that described how companies should account for cryptocurrency. Not a single rule out there. So everybody was just doing their own thing. Some people listed it as an investment. Some people listed it as an intangible asset. Some people showed it as cash and cash equivalents. It was all over the place, right? And so again, we have to be aware of, there are these emerging issues in accounting that maybe there aren't hard-lined rules for yet, and that affects our client. And we need to be aware that that might be an area of risk as well, okay? So understanding their accounting principles. Understanding industry or other sort of external factors that have an effect on our audit client. So in retail, right, it's a very cyclical type of operation. When do they have the majority of their revenue generated in retail? What period during the calendar year? Yeah, from Thanksgiving to Christmas, a significant increase in revenues during that time period in retail. Also, at the end of the year, let's say that like Earthware, right? Retail store has a December 31st year end. We would expect to see a significant amount of unearned revenue on their accounting records at that point in time. Why? Because they sold a bunch of gift cards at Christmas time and people haven't come in to actually spend the money on the gift card yet. Are you with me? So these are the kinds of things that are only applicable to a retail company. So those are the kinds of things that we have to think about for our audit clients. Where are there industry-specific things that have an effect on their business operations, right? What specific types of legislation does our audit client have to follow? And I mentioned this in a previous lesson. I can't remember which chapter it was. But if you're working for an organization that manufactures any sort of food products, they're overseen by the FDA. If you are working for, or if your client is in the business that has anything to do with the environment, there may be EPA regulations that they have to follow. Now, do those have a direct effect on the financial statements? Not necessarily, right? But we still want to be aware because they could end up having an effect on the financial statements. So we just want to understand sort of what those things are. And then just general economic events, right? I mentioned to you guys before, just understanding sort of what the current economic environment is gives you a base point to start to understand your client, right? I told you what kinds of companies do really good in a recession? Hot dogs and peanut butter and jelly, right? So I was on Smucker and I was on the name of the company is what? No, Freshmark is the name of the company. They produce Sugardale products. So bacon, hot dogs, they did really well during a recession, right? Because those are cheap products that all kinds of different consumers can still purchase even in an economic downturn. So understanding how just the economic climate can have an effect on your audit client, right? That's the kind of information that's going to be helpful for us to be able to identify areas of risk. Remember, at the end of the day, all of this information gathering is to help us identify inherent and control risk. We are trying to figure out where are there areas of risk in our audit client, okay? The only way we can do that is by gathering as much information about them as we possibly can. So industry and regulatory factors, again, we want to understand what objectives do they have? So for instance, right, Earthware may want to expand into new product lines. That may be sort of a 2 to 3 year objective that they have. What strategies are they implementing in order to achieve that objective, to get into this new product line? What are they doing about it? How are they going about it? And then for us as the auditor, where in that strategy could there be risk involved that can have an effect on that business? Okay, so understanding what their objectives are, what strategies are they putting in place to achieve those goals, and where are there areas of risk in those strategies that can have an effect on our audit client? Key performance measures. So you'll oftentimes see these referred to as KPI, key performance indicators. What do they use as a measuring stick to say whether or not they're performing well, right? Do they use net income? Do they use earnings per share? Do they use gross margin? Does Earthware use inventory turnover? If so, it ain't looking good this period, right? In that chapter 3 case study, we all said, each group said, inventory turnover is a problem here, right? They have slow moving inventory. So if our client uses that performance indicator as a measuring stick for how they're doing, again, we want to understand that. We want to understand that, and we want to understand what risk could that present to the financial statements, to the preparation of the financial statements. Sorry, key performance indicators. It was blocking the slide. And then lastly, the system of internal control. Now, we are going to have an entire chapter, chapter 6, where we discuss how does the auditor get an understanding of internal control, right? Because everything that we have talked about so far in these slides was all assessing inherent risk. Where are there areas in the financial statements that are inherently risky because of all of these different factors that we're looking at? Chapter 6 is going to help us assess control risk. Let's get an understanding of what their main business processes are, how they operate. Let's understand where are there points within those processes where something could go wrong, and then what are they doing about it, right? What control activities have they put in place in order to address those areas of risk? Getting an understanding of internal control. So again, this is something that we are going to talk about in much more detail, and you're going to have specific case studies for Earthware related to understanding internal control. But all of that in chapter 6 that we go through is all to assess control risk. So when we talk about that in chapter 6, you're going to see this model again, because we're going to be talking about how do we go about assessing control risk. Okay, so we are inquiring of management, performing analytical procedures, observing different things that are going on in the business in order to get an understanding of the nature of their business, what specific accounting principles do they use, what are some industry or external factors that have an effect on their business, what are their goals and what strategies are they implementing to achieve those goals, what performance measures do they use as a measuring stick, and then what does their system of internal control look like? We are gathering all of that information because with that, we can identify business risks that may result in a material misstatement, right? So think about that. In chapter 6, when we focus on control risk, what we are trying to do is figure out in their business processes, where is there a risk that a material misstatement could occur in the financial statements? That's what we are focused on, because when we identify those areas of risk, that allows us to allocate our audit resources appropriately, right? In the most effective way, because we want to allocate time and resources to the areas that have the most risk that there could be a material misstatement in the financial statements. If there are areas, if there are business processes, if there are financial statement accounts that have a very, very low risk that there could be material misstatements in the financial statements, then we don't need to spend a lot of time and energy on those areas, right? We're not worried that there's material misstatements there. Let's not spin our wheels in those areas where we're not even concerned that there's misstatements, right? This helps us create a strategic, effective, efficient audit plan where we're using our resources as effectively as we can to audit the financial statements of our audit client, okay? So with that information, we can identify business risks that may result in material misstatements in the financial statements, and we want to have an understanding of what is the client doing about their own business risks, right? Because it's not necessarily the auditor's job to point out all these risks to the client, right? We're doing this risk assessment for us because it's going to help us create a roadmap for our audit. We also want to know that the client is doing this too. Shouldn't the client want to know where there are areas of risk? Shouldn't the client want to know if they have control risk areas that are of concern? They should want to know that, right? If they don't want to know that, if they would rather be ignorant to that, that's a red flag for us too, right? Because we would want our audit client to be concerned with these areas of risk too, because the audit client, Earthware, should want to have accurate financial statements, right? And so in addition to assessing business risks for our own audit plan, we also want to see, is the client doing this? Are they concerned with business risks? Do they have processes in place where they're identifying business risks for their own good, right? So in addition to identifying them for our audit plan, we want to know, how does the entity go about, how does our audit client go about identifying risks for themselves? And once we do that, using our audit risk model, once we have all of that information, again, we can assess inherent risk and control risk, which will allow us to choose the appropriate level of detection risk. We are gathering all of this information so that we can assess inherent risk and control risk, because then that allows us to pick, to choose what level of detection risk are we comfortable with. And that has an effect on our audit plan, right? That's going to tell us what our materiality should be. That's going to tell us what accounts we should audit. That's going to tell us a lot. So we have to do this risk assessment as the first phase of our sort of detailed audit planning, okay? So that is an overview of the auditor's risk assessment process, right? Having conversations with the client, observing what they do, performing analytical procedures in order to get an understanding of the business so that we can identify areas of risk. Once we've identified those areas of risk, we can use this audit risk model to help us determine what the rest of our detailed audit plan should look like. Any questions about this risk assessment process? Got my water bottle today. Now, we are looking for areas where there could be material misstatements. Those material misstatements could be there because of error, unintentional, right? Someone makes a mistake, the internal control fails, something super funky and requires a lot of judgment and estimation, and they just don't do it right. Error, unintentional. Or we could find material misstatements or even immaterial misstatements, even ones that are low dollar value, because of fraud. The difference between a material misstatement with error and a material misstatement with fraud is intent. That's the difference, right? With fraud, there is an intent to deceive. We are trying to put false information out there for a variety of different reasons, right? Or we have stolen resources from this business and now we're covering it up. Either way, it creates a misstatement in the financial statements, okay? Now, the way that we handle misstatements that result from error is a little bit different than how we handle misstatements that result from fraud, as you can imagine, right? So we're going to get to that in a second. But before we do, let's talk about, when I say misstatement, what am I even talking about, right? When I say misstatement, I'm talking about there was an error in gathering the data that then resulted in the financial statement account balance, right? There was an error when they were accumulating all of their accounts receivable. There was an error in that data collection that resulted in accounts receivable having a incorrect balance, right? Just in accumulating the data went wrong. If we don't include something that GAAP says we have to, right? So sticking with the accounts receivable example, GAAP says that you have to measure how much of those receivables do you think you're actually never going to get, because the customers might not pay you. Do you remember what that's called? Dylan's like, we just talked. You remember what that's called? Bad debt expense on the income statement, and someone else said the other part. Allowance for doubtful accounts, right? We have to take our accounts receivable and offset it by the allowance for doubtful accounts, right? That's basically our estimate of how much of our receivables are we not going to collect. If you omit that, you just don't include it in the financial statements, that's a misstatement, right? It's not just because there was a mistake in there. It could also be because GAAP says that you're supposed to put an allowance for doubtful accounts in your financial statements, and you didn't. You omitted it altogether, okay? The incorrect application of accounting estimates. So if your audit client is using a bunch of assumptions to come up with that allowance for doubtful accounts or other types of estimation accounts, and those assumptions that they're using are completely unrealistic. Nothing about those assumptions seems logical or applicable to your client. That's a material misstatement, right? So they're not using their judgment and estimations in the correct way. That's a misstatement. Inappropriate classification. So you have this is intermediate 2. Let's see if we remember. You have a long-term debt arrangement with a bank, but you are in violation of your debt covenants. And that means that the bank can call on your loan. They could ask you to pay it back immediately. Even though it was long-term debt, now that it's callable long-term debt, which means the bank can ask you for your money immediately, that should no longer be as a long-term liability. That's now a current liability. That's a classification error, right? So they misclassified their long-term debt. That would be considered a material misstatement, okay? So again, what we are trying to do is assess areas of risk that could result in material misstatements in the financial statements. What are different examples of material misstatements? Here they are. Okay, so these are giving you different examples of what does a material misstatement entail. Okay, any questions about that? Okay, let's get back to the error versus fraud discussion. So as I said, errors, unintentional misstatements in the financial statements, and there are generally, two types of errors that we find as auditors. Known misstatements and likely misstatements. I'll give you examples, okay? I was out on an audit client. This was a client that had never been audited before. They had just been purchased by a private equity company in Cleveland. They were out in San Francisco. So because they're a brand new purchase for that audit client, we had to fly out there and perform an audit of their financial statements. We get out there and there's 2 people running the accounting department. And so we sit down with them and we're walking through and we're talking to them, just sort of prepping them for, here's the kind of evidence that we're going to ask for. Here's the sort of conversations we're going to have, just having that initial meeting. We try to give them some examples. We say, okay, like for instance, on your balance sheet, you show prepaid expenses, right? You all tell me what has to happen in order for them to have a prepaid rent, prepaid insurance. What has to happen for them to have a prepaid expense like that as an asset on their balance sheet? Like, what is the transaction that results in debit, prepaid rent, credit, cash? Don't think too hard. You had to have paid it, right? So they had to have cut a check to their landlord to pay for rent for a future period. That's what a prepaid expense is. You are paying for something that you're not using right now. You're going to use it in the future. So he said, okay, so like for prepaid rent, right? We would ask you to show us the check that you wrote to pay ahead of time for that rent. Any invoice that you received from the landlord, and then the check that you cut. And their response was, well, we haven't paid for that yet. Then, okay, well, so if you haven't paid for it yet, then it's not prepaid, right? So again, this was just, it wasn't that they were necessarily incompetent or didn't know accounting principles. It was just, they had never been audited before. They had never had these conversations and they sort of didn't understand maybe what was going on as much. So that was a known misstatement. We know that that's not a prepaid expense because you have no evidence that shows that you cut a check for your rent. That is a known misstatement. There's no ifs, ands, or buts about it, okay? A likely misstatement is oftentimes when we're thinking about estimation accounts, okay? So when you do, or not necessarily even estimation accounts, but areas where we're not able to gather all the evidence for all of the account balance, okay? So when you, for Earthware, look at accounts receivable, remember we said sampling, there's a giant bin of accounts receivable that Earthware has outstanding as of the end of the year. We cannot gather evidence about every single account receivable that they have outstanding. We can't do it. We don't have enough time and resources. So what are we going to do? Pluck some of them out. And we're going to gather evidence about that sample of accounts receivable. Are you with me? What if in that sample, we find that 10% of the dollar value of that sample was misstated? 10% of the dollar value of that sample was misstated. What we do is apply that 10% misstatement to the whole population, because we are estimating that if we found a 10% error rate in the sample that we tested, well, then there is likely to be a 10% error in the whole batch. Are you with me? Do we know that for sure? No, we do not. That is not a known misstatement. That is a likely misstatement, right? If we find an error rate in the sample that we test, it is likely that that same error rate applies to the whole population. If we would have gathered evidence about every single receivable, it's likely that we would have found a 10% error rate in the whole bundle, okay? So do you see the difference? Known misstatement, we know off the bat. The evidence tells us immediately that that is a misstatement versus likely. There's a little bit of estimation involved. There's a little bit of assuming involved when it comes to likely misstatements, okay? Which one do you think is easier to approach your audit client with? A known misstatement, hey, we found this and we know exactly how much it is, and here's the accounting principle and we can prove it to you. Or a likely misstatement, hey, we tested a sample and it's likely that that same error is in your whole population. Which one is easier to defend from the auditor's standpoint? What? The known, right? It's easier to say, you just told us that you didn't prepay that rent. You just told us that there's no check. That's a misstatement. Fix it, right? Versus, hey, we think because of our sample, you might have this big giant error in accounts receivable. Why don't you go ahead and fix that? That's a little bit harder to defend when we're having that conversation with our audit client, because don't forget, we're not doing this in a bubble as an audit team. We have to go tell the client about all the stuff that we find, okay? So having that conversation about a likely misstatement is a little bit harder than the known misstatement. Now, fraud. Fraud, typically we are looking at, again, two general types, either fraudulent financial reporting. You are misrepresenting information in the financial statements on purpose. On purpose, you have intent to deceive. Or what they call misappropriation of assets. That's a fancy way of saying you stole stuff from the company and now you're covering it up in the accounting records, okay? Either way, fraud, as opposed to errors, includes intent, okay? So now let's talk about how we handle misstatements when we find them. Focusing on fraud first, okay? On our audit team, what we should be doing to address the risk of fraud, to address the risk that there could be either fraudulent financial reporting, they are misrepresenting that financial information on purpose, or misappropriation of assets. They're stealing stuff and they're covering it up in the accounting records, okay? What do we as the audit team do about the risk of fraud? One, we have conversations on our audit team about it all the time. And again, I don't want you to think that we go into every audit assuming that there is fraud going on. Absolutely not. Because 99% of the time, there is not fraud going on. Will you find misstatements on your client's financial statements? Sure. But 99% of the time, they are errors. Nobody's trying to deceive, okay? But We still have conversations amongst our audit team. We talk to different employees within our client's business to sort of get an understanding of what's the tone, what's the environment like around here, right? We perform, again, analytical procedures. Where are there financial ratios or financial trends that sort of raise red flags? Like, hey, we weren't expecting them to achieve this level of net income and they blew it out of the water. Is there something weird going on there, or did they just have a good, fiscal period? We can perform analytical procedures that help us sort of point us in the right direction. Look at period end adjustments. At the end of our audit period, December 31st, we will ask to look at their journal entry record. And any material, again, using our materiality thresholds, any material adjusting entries that they make at the end of the accounting period, we would say, hey, can you please provide us some evidence for that adjustment that you made? It's not something that we expected. We just want to see sort of what the background is for that. So we would ask for evidence about unexpected adjustments. We're doing all of this to identify fraud risk factors. Okay, this is the fraud triangle. The fraud triangle presents to us the risk factors that have to be present in order for fraud to occur. Okay, so there's 3 of them. 1, incentive. There has to be an incentive for somebody to commit fraud, right? I'm going to get a bonus if I do this. My boss is going to get off my back if I do this. There has to be some sort of incentive or pressure, right? I have all of this pressure on my shoulders for us to meet these performance measures. And if I perform this fraud, I would be able to do that. Pressure. Opportunity. I have the opportunity. I have the access to the accounting system. I have access to the areas of these business processes where I can perform fraud, right? Opportunity. And then attitude or rationalization. I know that this is bad, but, right? I know that this is not the right thing to do, but if I get this bonus, I get to take my kids to Disney World like I promised. I'm not speaking from personal experience. We've not been to Disney World. Okay. So if Dylan's like, yeah, sure. If I do this, right, I would be able to accomplish whatever goal. I can have, everybody else is doing it. Everybody else in our industry fudges around with their accounting. Why shouldn't we, in order to achieve our performance measures, in order to reach these goals? Rationalization, right? Having that attitude. You can very quickly pick up on that attitude by just having conversations with people around the client's business, right? Do you feel that pressure? Do you see that tone in the environment? Having conversations with, I told you before, when you have conversations with the client, you'll be surprised what they tell you. You'll be surprised what they admit about what goes on within the business. So that's the primary way we can sort of get an understanding of what are the fraud risk factors for our audit client, okay? Once we understand those fraud risk factors, what do we do about it in terms of our audit plan, okay? Well, number 1, where there are high areas of risk, whether it be from error or fraud, actually, where there are high areas of risk, you don't want the intern doing the work for those areas, right? You don't want the intern in charge of performing the audit procedures in those high risk areas. I mentioned to you before in chapter 2, when we talked about sort of the structure of the audit team, right? There's interns and staff, then there's seniors that sort of run the day-to-day, managers and senior managers, and then the partners. High risk areas, and I also mentioned to you that there's always a performer and a reviewer, someone who performs the audit procedure and someone who reviews it. In these high risk areas, the senior and even sometimes the manager is the one who is performing the audit procedure. And then whoever is above them would be the one reviewing it. So assign the appropriate personnel to those high risk areas. Making sure, again, that you're evaluating management's judgment, right? When they have to perform estimations, what type of professional judgment are they using in those estimation calculations? Making sure that we are using, again, the appropriate level of personnel in those high risk and estimation areas, and then unpredictability. So we said before, we set materiality, right, in a quantitative way. But if you remember from chapter 3, there was the quantitative column, and then there's a qualitative column of how we assess whether something is material or not. This is where this idea of unpredictability comes into play. Yes, we said that we're not going to audit anything under $1 million. But if we see a bunch of stuff at $990,000 on their accounting records, maybe we want to add a little bit of unpredictability to the accounts that we decide to audit. We're allowed to do that. And by the way, you don't tell the client what your materiality threshold is, but the people that you most closely work with are accountants, and they know how to do it. Like, they know what the auditors are looking for, and they know how to calculate materiality. So we don't straight up say, hey, we're only going to look at everything over $1 million. We don't tell them that. But they understand our process, and they understand materiality. So they oftentimes know or can guess around about what materiality is. Let's throw a couple curveballs in there. In those areas of high risk, let's look at account balances. Let's look at transactions that even fall below our materiality threshold. Again, just to provide us with more assurance about those high risk areas. Provide us with more assurance about those high risk areas. When we are done with our audit, right, what we would have to do is take our total misstatements and compare them to our materiality threshold. If we have an accumulated amount of misstatements that falls below our planning materiality thresholds, then we're okay, right? We have to communicate those misstatements that we found to management. We have to advise them, hey, so that you don't do it again, it might be good to make some adjustments in your accounting records for these misstatements that we found. But we don't require them to make any adjustments if the total amount of misstatements falls below our materiality threshold, right? If it's above our materiality threshold, we first discuss those material misstatements with our audit client, and we suggest that they make adjustments in their accounting records. We cannot go into their accounting system and make adjustments. We are an independent third party. So all we can do is suggest to them, show them our evidence, and suggest to them that they make adjustments in their financial statements. We can't make them do that, okay? If they choose not to do that, then we don't get to issue our thumbs up opinion though, right? That's sort of the carrot that we dangle in front of them. If you want a clean audit opinion, that unqualified audit opinion, these adjustments have to be made. Otherwise, we would have to issue either a qualified opinion, except for these areas, everything else looks okay, or an adverse opinion. There are material misstatements in these financial statements all over the place, okay? So that's what we do, again, when we're at the end of our audit sort of process. So I'm sort of jumping the gun here a little bit. We're going to talk, I'm going through it quickly because we're going to go through it in more detail in upcoming chapters. But that's sort of what we have to do once we have gathered all of the evidence about the financial statements and we know what all of our misstatements are. If we find misstatements, so that process that I just talked about was assuming that the misstatements that we found were due to error, unintentional. They were not trying to deceive anybody. They just made some mistakes. Okay, that's the way that we would handle misstatements that we found that were not intentional. If we found misstatements that we believe are as a result of fraud, there was intent to deceive. Number one, we need to do as much digging as we can. We need to find as much evidence as we can that this was intentional, that there was intent to deceive. And sometimes our audit firm may not have the resources to do that. We may have to engage with a forensic audit team that would come in and help us gather evidence about that. Because remember, forensic audit teams, their number one task is to find fraud, to uncover fraud, okay? We would have to discuss what we found to a level of management above who we believe is perpetrating the fraud. Okay, we would discuss our findings with a level of management above who we think is perpetrating the fraud. Now, what if we believe that it's the top level executives perpetrating the fraud? Who do we talk to? Who's that oversight body? Yeah, the board of directors, more specifically, the audit committee of the board of directors, right? They are sort of the umbrella oversight board over the entire entity, over all of the executives. And within that board, we talked about this, I think, in chapter 2, within that board is a committee, the audit committee. They are responsible, we sort of report to them. So if we find fraud, we would, at that executive level, the only place we can go is to the audit committee. That's the only governing body above those top executives, right? We would have to report that information to them, and then we would have to consider whether we want to withdraw from the engagement. Do we want to continue our audit procedures with this audit client, or do we want to wipe our hands of it? Because remember, at the very, very beginning of this chapter, we talked about engagement risk. What happens if we continue the audit procedures and all of this fraud becomes public, right? That can have an effect on our reputation. We want to be aware of that. So we have to decide whether we want to continue with the audit or whether we want to withdraw. Now, the final sort of concept or topic that I want to talk to you about is documentation, okay? So we are performing all of this risk assessment. We're gathering all of this information about our audit client, about inherent risks, about control risks and their system of internal control. We have to document everything that we have found. We have to document all the conversations that we have with them. We have to document any observations that we make about their business processes. We have to document everything. One of the sort of baseline things in the audit profession is that if it is not documented, it never happened. So if you had a conversation with the client about fraud risk and they informed you that they do feel pressure and there is a sort of certain tone going on in the environment and you don't document it, it's as if that conversation never happened. It can't stay in your head. It has to be documented in some way. So what you're doing for Earthware is documenting your understanding in a questionnaire. A lot of times audit firms will have sort of templates that they go by to gather all of this information. That's what you're using for Earthware. But we could also use flowcharts to document their business processes. We can write memos about the conversations that we've had with them. A variety of different methods to document, but the key understanding is all of this information that you are gathering in order to assess inherent risk and control risk has to be documented, okay? So that's the end of chapter 4, right? Our audit risk assessment. Does anybody have any questions about the content?
I'm not sure.
She's not sure. Are you sure? Okay. So when you open up your case study, it's going to look like this. Hopefully your team got together on Wednesday and you already sort of started tackling it. I mentioned to you that the thing that you are most concerned with in this questionnaire about understanding your business is the nature of the entity. So they're going to ask you questions about who are their key customers, right? Has management had a lot of turnover? You're going to answer those kinds of questions. All of the questions that you are responsible for are highlighted in yellow. You're going to include your responses here in these boxes. And then once you do, it creates a nice printout. This is what I actually use to grade that only shows the questions that you were responsible for answering. So when you type your answers in that questionnaire tab, it automatically populates it in this printout tab. And that way I'm able to see just the answers to your questions. Now, I think it is relevant for you to read through the other questions and kind of get an understanding of what were the answers to the other questions that, yeah, you're not responsible for answering, but might shed a little bit of light on the questions that you do have to answer. So take a little bit of time reading through those as well. Once you have filled out each of the yellow boxes in the questionnaire, one member of your team will submit this in Moodle. Yes? So that is the audit team assignment that's due on Monday. The other assignment that is due on Monday, homework chapter 4, Essentially, what this problem is asking you to do, the internet assignment, is to fill out that questionnaire for a real company. Okay, so here is a link that will take you directly to where you can find the financial statements of any company of your choosing. All you have to do is put their name in here. I'm going to put Target because I love Target. It brings you to where you can find their 10K annual report, and then you can read through their 10K to be able to answer those questions. You only have to answer the yellow highlighted questions. You do not have to fill out the entire questionnaire for this company of your choosing. Only those yellow highlighted questions. So essentially what you want to do is take the template that you use for Earthware, delete all the information from Earthware, include the company name that you chose, and then answer the questions based on what you read in their annual report. Okay? Anybody have any questions about that homework assignment that's also due on Monday? Okay, so I already provided you with the link of how to get to the SEC website. All you have to do is find the company that you want to look for, click on their 10K report, and then read through it to be able to answer the questions. I would highly recommend that you use the Control F function in the annual report. You're trying to find information about their customers, do Control F and look up customers, right? Because that'll help you navigate through their annual report to sort of find the information that you're looking for, okay? So you have the next 25 minutes to work on your case study. If your group gets done and you want to work on the homework assignment, that's fine too. But you have the rest of class to sort of get in your audit teams and finish that up, okay? Does anybody have any questions about that assignment? Okay. I will be here to answer any questions that you do have.